Today, we are very happy to have Tim came from NU. He's a macroeconomist. He actually was with us a while ago. I just learned about that for a short time. So some of you might actually know Tim back then. So Tim recently is interested in the distribution effect of monetary and fiscal policy of the economy. And today he's going to share us with one of his recent research, and the title is Money Credit and the Equilibrium Imperfectly Competitive Banking. So without further ado, I'll give the microphone to Tim. And Tim, as I said, you have 60 minutes of presentation and 15 minutes of questions. And Tim had mentioned that he doesn't mind people calling in if you have any questions. So Tim, the floor is yours.
All right. Thank you, Simon. Thanks everyone for coming and having me here in this talk. It's always a pleasure to give a talk at UWA, given that, Ken, when he was the head of school in UWA, you guys all gave me a chance when I was just fresh out of the market. It was a huge gamble because I didn't have any publications, and I'm still struggling to publish like everyone else. So thank you, Ken, and thank you, UWA. So this paper is joint work with Alan Head, who's at Queen's in Canada, and my PhD student here, Sam or Yingman, and also a young graduate from finance here who is now at University of Sydney, Isaac. I think Sam and Isaac are in the audience today, so do say hi to them afterwards if you have time. In particular, Sam is expected to be on the market within a year or so from now. So we hope to see him in the PhD conference, and so watch out for him. So this paper essentially is our quest to try to understand better the role of the connection between traditional monetary policy, so think of it as inflation targeting policy, working through the banking sector. Now, in most macro models, for example, since the crisis, there's been a lot of complaint about standard macro models not paying too much attention to the plumbing or the details of financial markets or banking system. Now, that's not to say that there are no models out there. So there are plenty of models out there. So then the question is, why do another model? So we're going to show that in our approach here, that in particular, we're going to have a definition of a banking sector where the notion of market power or the nature of competitiveness in this banking sector is going to be an equilibrium outcome. In most macro models, when we think about banking models, the banking sector tends to be either perfectly competitive or on the other extreme, it's completely monopolistic. Now you have varieties of models in between where, for example, people assume that the banks are monopolistically competitive. The monopolistic competition type of model borrows from, for example, in international trade, general equilibrium models. In those models, typically the elasticity of demand for products are constant. So unless you make some additional technological assumptions, which means that the notion of markups tend to be constant in those models unless you introduce additional sort of exogenous assumptions, right? So what's going to be different in this model here is that the notion of markup will be endogenous. And in particular, we're going to see in equilibrium, we can also rationalize a distribution of markups across banks for what would otherwise be the same product being sold by the banks. And this is something we do see in the data, and standard theory doesn't really match up with that observation very well. So which is why we want to take a different approach here and use a kind of a consumer search model in IO. And I'll explain what that model is afterwards. Okay, so for people who just arrived, in case you want to follow up later on, This is going to be the permanent website link for the paper. I've also copied the link onto the chat box for today's talk. So you can click on that and look at the link. So in future, the full version of the paper will be there. Source codes for what we do will be there as well. All right. So let me just begin by a few motivation. It's well known in the data across several countries that banking sector is one of the least competitive sectors. In the US, for example, you have high profit margins. There's different measures. For example, using the Ross-Panzas age statistic, you have imperfect interest rate pass-through. If you measure in terms of the number of banks, the top 3 banks across several countries, here I have a few. For example, in Europe, Japan, US, they tend to dominate a huge share of asset holdings in the market. So, and all this data is publicly available. So why is this a concern? Closer to home, the ACCC, for example, has been quite concerned about banking sector market power. The Productivity Commission, for example, had a recent inquiry. The report here basically says that there is a concern about banking market sector, market power, because ultimately this leads to welfare for consumers that could be eaten away by non-competitive banks. Elsewhere, Bank of Canada, for example, they're also concerned about these issues. And from a macro perspective, for example, in the speech by the former Assistant Governor of Bank of Canada, Carolyn Wilkins, she said that it's still kind of an open question in terms of how exactly the transmission mechanism of monetary policy through the banking sector actually works. So this paper, I would like to think, is another sort of contribution to trying to understand that mechanism. Okay, now, how about economic theory? Now, if we focus on sort of deeper microeconomic theory, where we try to rationalize why institutions like banks or in general financial intermediation have a role, it has to do with information. So think about a hypothetical world where all of us here would like to borrow and lend from each other because we face idiosyncratic consumption risks. But the problem is some of us may not trust each other, or all of us may not trust each other. So think about the extreme case where we do not know each other's trading histories. Then the sort of classical general equilibrium idea of Arrow-Debreu doesn't work, because it's impossible to sustain trade by writing IOUs to each other, right? So in other words, we can't write contracts with each other that say, I'll borrow from you and I'll promise to repay in the future. So this is where potentially institutions like banks come in, because banks potentially can aggregate these idiosyncratic risks and essentially step in and provide an insurance role. So in a well-known paper by Alex Berenson, Gabriele Camara, and Chris Waller, this is in JET, they showed that banks essentially help to improve welfare when you have this information problem. In other words, when exchange is anonymous, when people cannot write contracts privately with each other. So in the absence of institutions like banks, then you have a worse equilibrium outcome because there will be inferior trade or no trade at all. And this result holds even in more general situations. So there's a follow-up paper by Paola Boal and Chris Waller.
Tim, there's another welfare improving function of banks,
yep.
And that is that they borrow short and lend long. So they yes. perform a maturity transformation function, which is valued by society, and that's very difficult to do. Banks pull it off.
Exactly, that's true. But if you go back to neoclassical general equilibrium theory, which is the linchpin in all the macro models we see in the mainstream today, those models underlying this arrow-de-Broglie theory literally says anything else apart from arrow securities are essentially redundant assets, right? So in other words, in theory, if you could write these private contracts, you could write a contract that's arbitrarily long or short. So it doesn't matter. And so this row of maturity transformation by banks would be redundant in that sort of world. But I do appreciate your point. So in reality, the arrow-de-Broglie world doesn't, it's not true. You don't see that, which is why banks also have a role in that setting. So another way to say what I'm trying to say is that there's a role, as Ken said, that banks are there to transform sort of short-term risk and balance it with long-term risk. So that's not the focus of this paper. Here we are going to focus on this other aspect of banks or financial intermediation in terms of moving excess liquidity around. Is that okay?
Yeah, sure. Thanks.
Okay. All right. So these results tend to be sort of couched in a framework where banks are perfectly competitive. So then the natural question to ask is, what if the banking industry is not perfectly competitive? And this is where our paper comes in. So let me just outline what we do in this paper. As I mentioned at the beginning, if you look at the data, we do see that, and I'm going to show you some empirical evidence using microdata, that indeed, for the same class of loan products, you would expect the law of one price to hold. However, we do see that these same products have different prices. So this is like a classic problem in IO as well. So back in 1983, Ken Burdett and Ken Judd were asking exactly the same question. Why is it that homogeneous products have different prices? Think about, I don't know, toothpaste, but maybe toothpaste is not a good example because there's a lot of variety across toothpaste. But imagine the same product, you do see a dispersion in prices. And so we're going to try to understand that using the model that we have. So that's sort of like an empirical benefit of the model that we're going to consider. But the other side of it is that it has a normative implication as well. The model that we consider, because it can rationalize this empirical fact about loan rate dispersion, in particular, the markup of loan rates over the cost of borrowing by these banking institutions, that in the model is going to be a consequence of equilibrium market power. So these banks are going to behave in a way where they are balancing the need to maximize profit by charging a price markup over their cost of funds. But at the same time, they also worry about attracting customers or losing customers to other banks. So we've got an extensive versus intensive margin trade-off for these banks here. So as a result, in equilibrium, we're going to see a distribution of markups across these banks who otherwise offer the same product. Now, let me come back to the first point here, the data. In the data, we're going to focus on a particular measure of consumer loans. So for all intents and purposes, these are basically the same type of loans. And we're going to see that there will be what we call residual markup dispersion, meaning after we control for all possible confounding factors that could explain the dispersion, we still have residual dispersion in the data. And so then a natural interpretation from the point of view of our model would be that this has to do with the kind of noisy consumer search and market power that the banks have. So then this leads to the question of, is the original result that banks are welfare improving always true? We're going to see that the answer will be, it depends. In some states of the world, in particular, when inflation is sufficiently high, then banks will become essential. So then the result is not as strong as before in the literature. In particular, we're going to see with low states of inflation, which is what we see in Australia and many other developed countries, it turns out these banks are actually, from an ex-ante welfare point of view, making consumers worse off. And that sort of justifies why the policy regulators I mentioned earlier are concerned with market power by these banks.
Tim, can I ask a quick one?
Yes.
This might be trivial, but wouldn't the ability of a bank to be able to perform this welfare enhancing function or to smooth consumption across customers will be higher if they have a higher number of customers, right? Like they're basically balancing out risks, right? Or like, fluctuations in the consumption profile of consumers, right?
Yep.
Or income profile. If you have more people to balance it over, you'll be able to do a better job by construction.
Yeah, so that's going to be part of the equilibrium trade-off consideration by these banks in our model.
Okay.
So I'll explain a bit more in terms of this noisy search model, but yeah, the bank now has to balance out trying to attract more customers. That way it can still maximize profit without having to charge too much of a markup.
And that also benefits the consumers in your model, if they're better able to do it.
Right. But the problem is then ex-ante consumers will be faced with a problem that these banks will be appearing as if they're charging different prices.
Mm.
And so then, depending on which price you're going to draw as a consumer, your welfare will be different, which is why ex-ante, you could be better off or worse off.
So, sorry to press this, but so then there's no network element to the banking service that I choose, right? I mean, I wouldn't go to a bank which already has a lot of consumers then.
Oh yeah, so that element is completely outside of our model.
Okay, got it.
Yeah, we don't have that sophisticated sort of two-sided platform result. Yeah. Okay, so if it's clear, I'll move on. Oh yeah, so finally, because these banks have equilibrium market power. Oh, sorry, yeah.
Sir, I mean, these loan markups, these loan rate markups is just for the loan service or for all the financial service that the banks provide to the customers?
That's a very good question. In reality, banks have more degrees of freedom. For example, they can do markups on the loan side. Simultaneously, they could do markdowns on the deposit side. So they can earn profit margins on both sides, right? Now, at the moment, we're not clever enough to be able to consider both at the same time. So we're going to have a little story or hack in the model where in equilibrium, the cost of funds or the deposit rate will always be constant and it will be equal to the risk-free rate. So the story we're telling here is just looking at the loan side. Okay, so it's just one moving part.
Can I also ask one question related to the measurement of this dispersion?
Mm-hmm.
Yes, here, do you mean that the level of the markup actually is negatively correlated with the dispersion of the markup?
So when I say markup, this is the average markup across the different markups. It's the level.
And then negatively correlated with the dispersion. So what do you mean the dispersion? Dispersion across the banks or just the dispersion across the customers of the bank within one bank?
So we're going to see in the data afterwards when we look at the micro level, this would be dispersion across the banks and across states.
Okay.
And then we're also going to aggregate up and look at it at the national level. Even at the national level, there is still dispersion.
Okay, so here the positive and the negative correlation, then when you use different measurement for dispersion, when you use CV, and when you use as standard deviation, the correlation, it is opposite.
Exactly, yeah.
Okay, okay.
And we do get both directions as an implication from the model as well. So that's kind of the punchline.
Okay.
From the empirical part of the model. Okay, so yeah, because of this potential for banks to extract, rent from households, then there potentially could be additional instruments available to a policymaker to help overcome this new channel of inefficiency. So then we're going to consider this as the last experiment and think about a additional set of policy tools where we call it an optimal redistributive liquidity provision policy. Okay, so let me go on. So we're going to first look at some reduced form evidence from the data, and then try to use that to characterize some regularities in the data. And when I say data here, I'm looking at the US. At the moment, we only have access to this data from the US. And the point is that the model is going to be able to predict in a stylized way this positive correlation between average markups and the standard deviation of the loan rate of the markups. Loan rate markups. Alternatively, if you use the coefficient of variation, which is just standard deviation divided by the mean, then it's going to be a negative relationship. Again, the model is able to account for that. So we take that as sort of an external validity check on the model, such that when we talk about policy experiments, at least the model is able to have some degree of realism here. Okay. Second point, what we're going to find is that, as I said before, compared to the existing literature, now banks, in terms of its role as one that ensures risk to idiosyncratic consumption opportunities, it's no longer true that banks are always welfare enhancing. The reason this is the case in our model is because with market power, and in particular with market power that depends sensitively on policy. When policy in terms of inflation is low, the banks will tend to behave as if they're more like monopolists. They will exploit the markup pricing channel more. And this basically extracts rent from households. But as inflation is sufficiently high, and we're going to see that in our calibrated model, it doesn't have to be too high. It can be quite reasonable in developed country terms. Then the banks will begin to behave more like competitive banks. In the limit, they will behave like the original perfectly competitive banks. But in the end, we're still not going to get back to the original welfare outcome, simply because there will be still some banks who are charging a higher markup than others.
Tim, excuse me. The stylized facts from banking is that bankers typically dislike low inflation because it squeezes their margin. Now, I think you're saying something different to that with your model.
Right. So here we're going to see in equilibrium, there will be a distribution of markups, and at low inflation, if you like, the dispersion in this distribution is a particular form where there will be more banks who tend to behave like as if they're charging a higher loan rate over their cost of funds. But of course, conditional on who these banks are, they would still dislike inflation simply because inflation raises their cost of funds. So this is true across all banks. As inflation gets higher, their cost of funds is higher, so they're going to have to decide if they're not charging a higher markup in terms of loan rate, then they're going to suffer, right? So which I think that agrees with what you just said.
Okay, thank you.
Okay.
Yeah, so Tim, following the question by Ken, I think that in that case, as you described, that it could be a little bit tricky because now you need to think about how sticky the interest rate that the bank can charge to their customers, right? In the scenario of the inflation, although the cost could be rising, but it depends on how how sticky their interest rate is to their customers. That would determine their markup.
So I think, if I'm not mistaken, your question or statement is about dynamics. At the moment, the results we have, we're just comparing banking equilibria across steady states or long run situations. So yeah, I can't really answer that question because we don't know what the dynamic behavior is yet.
Okay.
Thanks. But that's a really good point. In terms of product markets, there's similar models like ours, and they have shown that you do get this kind of price stickiness result without assuming price stickiness, which is what people do in the more mainstream New Keynesian literature. Here, with price dispersion, it will look as if prices are sticky because it's actually optimal for some firms not to adjust their prices. So I think we're going to get that result here too once we write our second paper, which is about dynamics. So, but at the moment, I can't say much. Thanks. So that's the interesting sort of economics of the model, where you get this non-monotone effect of inflation on banks' incentives. As a result, we get to see that for the policymakers' problem later, this non-monotonicity also features in terms of the optimal policy. So that makes the policy problem a slightly more difficult one, but also an interesting one from economic analysis point of view. Okay, so the last summary about the results is that in terms of policy experiments, we're going to see that if you introduce additional liquidity management policies, and we're going to consider optimal policies here, we're going to get this somewhat, if you come from a textbook Keynesian point of view, it will look as if it's counterintuitive in the sense that when aggregate demand is high, the central bank is actually optimally prescribing an injection of liquidity to people who need it. So then from a Keynesian model point of view, this doesn't make sense because it's going to stimulate more inflation and so on. But in this model, it's going to be different. It's going to actually help balance out, on the one hand, market power by banks, but on the other hand, providing enough liquidity for consumers such that it is still welfare improving. Now, although I say it's counterintuitive from a Keynesian point of view, it's actually quite intuitive if you think about present day Federal Reserve practice. Apparently in the charter for the Federal Reserve, there is a kind of mandate for the Federal Reserve that it is meant to be always ready and available to provide additional liquidity when the demand for liquidity is high. So this result kind of gels with that mandate in the bank's charter. Okay, so let me quickly move into the empirical evidence. So much of this work is thanks to our co-author, Isaac, somewhere here. So here we have to look at microdata, which is available from a private provider called RateWatch in the US. I think they're sort of like the Australian version, which is called CanStar, where they compare different loan products provided by financial institutions and banks. And you can basically purchase this data. So we're quite happy to have access to this here. So in the data, you have information about the branch level at every state. So, and you can look at who owns these branches. So these are indexed by I, and the county in which the branch belongs to, and the state in which that county belongs to. And T is going to be the date at which this information is recorded by RateWatch. So using all this information, we can construct a markup measure, which is basically the difference between the rate advertised by these banks. And now observe that these are rates for the same loan product. So we're looking at consumer loans. In particular, these are what we call tier 1 consumer loans. So they are sort of high quality loans. And we measure markup as a deviation from the federal funds rate. So this is just a proxy here, okay? And we can construct two ways of markup dispersion. So given markups, you can either do standard deviation or you can do coefficient of variation. Okay, just looking at the raw correlation, which is on the left panel here. On the top, we have a measure where on the horizontal axis, you're looking at the average markup in the raw data. And then you have the standard deviation as a measure of dispersion. So in the raw data, straight away, you can see a very clear positive correlation in terms of standard deviation as dispersion. If you prefer to use coefficient of variation, it's going to be downward sloping, okay? Now, on the right side of this picture here, we have the orthogonalized version of these markup measures. When we say orthogonalized, we mean let me just forward a bit. We are taking the raw markup series and regressing it against other confounding factors. I'm going to call these local confounding factors, meaning you could have regional variations due to various demand side features. You could have local market competition that's different from one county to another. You have different bank network effects, banking characteristics. So all these things, think of them as the X variables on the right-hand side. So we're going to control for all these things. And so the orthogonalized markup will be the residual here. So another way to call it is the residual markup. So the idea is that since our model is very simple, we don't have too many moving parts, so we can't explain all the possible factors driving markup dispersion. So hence the stuff that we do not explain, we're going to control in the data. And we're going to interpret the residual markup here as being driven by the one factor which is coming from our theory. Is to do with noisy consumer search and market power by banks, okay? So coming back here now, that's what we mean by orthogonalized markup measures. So again, if you do this orthogonalized version, you still see a clear relationship as before in the raw data series, okay? Aggregating up to the national level, in terms of standard deviation measures, you also see a clear pattern here. So then, if you want to do things a bit more than just looking at correlations, we now run regression on our residual dispersion measure against the average markup, now controlling for other macro factors that we do not explain in the theory. So this could be business cycle effects. So we're going to control for state level effects as well. And time here is going to control for the business cycle effects. So what we're going to get from this regression is, the important thing is this sign here. And again, you're going to see that you have this positive relationship in terms of standard deviation measures in relation to the average markup, okay? At the national level, if you do it for either standard deviation of CV, again, you see this positive for standard deviation and negative for CV in terms of either the raw series or the orthogonalized series.
Okay. Can I ask a clarification question? So,
go ahead.
I mean, I might have missed this, but how is this different from, like, if you wrote like a simple spatial competition model, right, the IO model? So how is this different? You'd get the same predictions there as well, right?
In spatial competition?
Yeah, like something like when Walmart comes to town, where do they locate in a particular county, right? And how much spatial competition there is. Wouldn't you get similar predictions there as well?
In terms of dispersion?
In terms of dispersion and like the relationship between markup and dispersion, no?
Yeah, that's a good question. I actually don't know that literature result well enough.
Okay.
But the point of this exercise here is because we do not have a regional model in mind, So we cannot explain all those spatial competition effects. That's why in our regression, we are controlling for all those things.
So you mean that the bank branch network kind of controls for the spatial competition as well?
Potentially.
Yeah, okay.
And also indirectly, the controls for the county or the state effects.
Yeah,
simply because our theory is so simple that, we don't have a geographical model.
Tim.
Yeah.
Tim, hi, can you hear me?
Yes, go on.
One question about the markup. What kind of loan in particular do you have there? You talk about consumers loan. Which loan? What maturity?
So it's just one type of loan. This is in the rate watch definition. This is the personal unsecured loans. Tier 1 is like the low default probability people. Does that answer your question? Yeah. So,
excuse me, Tim.
yes, go on.
Just on the, you're using the state mean. Why don't you use the bank, using the bank, the markup at the bank level rather than the state level? I don't know quite get that.
Oh, I see. You're
this
talking
one.
about this definition here?
The next one, it's actual, there's a regression. Next, the next one.
Next one?
Yeah, this one here, yeah. What do you mean by state? Is the state level of dispersion, state average markup, or what?
So observe that now when we get to this level where the only index is S and T, what we've done is we've basically aggregated up further. So we've clustered all these branch level, blah, blah. So we've summed up across all these things and just focus by state. The reason is because we don't have enough observations. If we were to, zoom into this even more micro level.
How many banks do you have?
Good question. That's Isaac, are you here? No, he's not.
I think it makes more sense if you aggregate at the bank level. So you have B and TAM instead of state and TAM. The state is the average across the banks, right? Assuming the markup is very different across the banks rather than across the state.
So yeah, the variation now is across date and time, right? So we have aggregated up across all the banks. And Isaac just responded on the chat saying in the data we have about 4,000 banks.
So that's 4,000 branches, another 4,000 banks.
Branches, yeah, that's right.
Because assume the US is the domestic market is highly integrated, then the dispersion or markup across the states should be very small. But if you look, there may be difference across the banks.
There would be. So, but the point is, we have like a macro model here, and we want to get evidence after controlling for all possible variations driving dispersion, right?
Yeah.
And so by doing that, controlling for all those things, then we can focus on either state level or even the national level. But the point is, it doesn't matter because the conclusion is pretty resounding across the different estimates. They're always positive in terms of standard deviation versus average markup, or negative in terms of CV versus average markup.
Yes.
Can I have a quick question?
Yep, go on.
So this is kind of echoing what Emil asked earlier. Do you have, I understand that you're looking at low default tier 1 loans. Are the maturity for all those loans the same?
I believe so. So that's the reason why we focus on that class. For all intents and purposes, they're the same loan types.
No, loan types is fine, but like, for example, a consumer loan can also be, say, for example, for 1 year, 5 years, or 30 years, right?
I see what you mean. Yeah.
And if they are of the same maturity, then it's fine. If they're not, then the problem is that you're constructing your markup and dispersion, specifically the markup measure, is essentially a difference of the federal funds rate. And I'd assume that by construction, it will vary if you vary maturities, because federal funds rate is obviously very short-term maturity. And obviously, as you go further, you basically just get that extra delta. So if you have varying maturities, I would assume this result is expected.
No, but that's the thing. So Isaac here, he's the one who's been playing with the data. It's basically for the same maturity.
Okay.
Yeah.
Fine.
Oh, and just to correct myself earlier, I should have done more of the numbers homework. We have 4,000 banks and 16,000 branches in the data. Okay.
So Tim, can I ask you a question about following? I think a little bit. I have the similar confusion with Henry. So here, when you run that regression, what is the theory in your mind? So because you just run regression with the data at the state year level, and you control for state fixed fact, the US fixed fact now, and then you are making use of the state-specific shock as a variation to identify the relationship, right? So, but at the beginning, you really care about the market structure, the monopoly power, all these things. But here now you're making use of the overtime variation for each state. It seems to me, okay, the two things are not very consistent, because now for monopoly power, so I do think that there is a huge variation over time at the state level. Or your regression just want to tell a different story?
So if you look at this regression here, dispersion markup, so like I said, there's many confounding factors that could be driving these markups and dispersions, right? So once we've controlled for the things we cannot explain from the model, then you still have residual dispersion and residual markups. So then the question, it sort of begs the question, what else could be explaining that? And this is where in our model, the one mechanism is going to give you the same kind of direction of this relationship. So in short, that's the theory I'm going to show you in the next section.
Tim, sorry to belabor this point, but I think what Sean is trying to say is that if your story is, the monopoly story, then shouldn't you kind of probably have a sort of a Herfindahl index for the size of, banks, and actually use that to explain dispersion rather than, aggregate it at state level?
Yeah, the problem with something like Herfindahl index is it kind of is couched on standard demand supply theory, where you need to calculate some given demand curve elasticity, right? But
you can,
yes, but the thing is that if you're aggregating at state level, I don't quite see how you're capturing what you said in theory. You see my point?
Okay, so let me just say, let's not get too hung up about this state level stuff. So this is kind of motivating the idea that there is this relationship at the state level, but at the national level too, you still have this relationship. So even if you wash out the state level effects, right, we still have that positive relationship in terms of standard deviation, or negative in terms of CV.
Okay.
Yeah. So we are not interested in trying to, have a very detailed model that explains all this regional or state across state kind of effects, because we don't have that model. We ultimately still have a macro model, but it's still a macro model with enough micro features to explain market power and dispersion. In particular, we're explaining this residual dispersion after having, control for all the other factors that we can explain.
I think one way you could explain it is that ideally what you want to have is borrower level data, and you don't have that data, so you have state level data or bank level data. So you might want to say that you assume that each state is a borrower, and you are controlling for many covariates related to that state, and then that's one way you could talk about risk regression. Because ideally, what you're missing there, which is a big missing aspect, is borrower level data.
So you mean the demand side stuff, right?
Yes, I mean, the most important component in the bank loan is who is the borrower.
Yeah. So it's a bit tricky. So this rate watch data is about what the banks advertise. Now, who knows, in actual exchange between bank and customer, sometimes you could get different rates, right? That's something we do not observe. A classic example is like housing mortgage rates. The bank advertises, 5%. I go and sit down with the bank's broker. I can potentially negotiate a different price, but that's not going to be really reported unless somebody manages to get access to every loan contract level data. But again, we don't have that here. So this is not perfect, but it kind of gives us a pretty good picture already, and it's robust across either state level or national level measures. Is that okay? All right. So to summarize, there is this positive relationship between average markups and a measure of dispersion, which is standard deviation. Alternatively, if its coefficient of variation is going to be negative. So then you might want to ask, what might be an explanation for this residual relationship, given that all the other stuff we can explain has already been controlled for? So then this is where we get into the model, okay? In the remainder time, I'll just very quickly outline the model and then jump to the results. So here's a model which has origins in, you can think of it as an overlapping generations, Maurice Allais sort of model, where there's exposed the need for people to trade because they have different valuations over goods. Think of them as idiosyncratic risks, and they would like to smooth out the consumption, right? Now, instead of overlapping generations, we have this kind of information separation or spatial separation in terms of consumers. So here, think of a consumer standing at period T, where ex ante, they are all identical. Long story short, we're going to have a model where at the end of every period, they're going to enter this standard, Vorasian market, and they happen to have quasi-linear preferences. And from micro, we know with quasi-linear preferences, your demand functions have no wealth effects, meaning any asset holding choice you make at the end of that period will be identical regardless of what wealth level you began with in that period, okay? So as a result, as you begin every period T, you're going to have the same initial money balance. That's just going to keep the model tractable. We don't have to deal with heterogeneity from period T to T+1 and so on. In between, we're going to have ex post heterogeneity because some of these people will face a taste shock. Think of them as having some probability N each person that they want to consume in this first market. We're going to call this DM, which stands for a decentralized market. This is going to be a market where people are anonymous. If you were to microfound this, you can think of this as a situation where there is extreme information friction. So people would not trust each other. If I were to promise you with an IOU, you wouldn't take that IOU. Now, if nobody's going to take IOUs from each other, then there will be no trade. And this is where potentially banks come in to help smooth out this friction. So the banks we have in mind will be, the focus here will be on the loan side. They will be posting loan rates and consumers will be searching for these loan rates, okay? Now the consumer search problem is originally due to Burdett and Judd, which is a noisy search model. it's kind of like in reality where you want to buy an airline ticket, either online or physically, you would go to different vendors, right? You would look for 1, 2, 3, or 4, and then ultimately you decide which one you want to buy from. So here we're going to restrict attention to the case where consumers either have 0 bank contact, 1, or at most 2. You can generalize this theory, but we don't need that, just to keep it simple. The contact of the number of banks will be given in a probabilistic way. So it's as if the consumers are randomly searching for either 1 or 2 or 0 banks, okay? If you end up exposed with a case of 0 bank contact, then the only way you can potentially consume is to hold enough money balance to buy goods from sellers. If you need 1 bank, you can pay with your own money, or you can top it up with a credit line that you would have established with this 1 bank. If you meet 2 banks, then you have a different rate and so on, okay? So now, I wouldn't have time to talk about the deposit side, but effectively we have a perfectly competitive clearing market between the banks, such that some banks who take on too much loans or who have too few loans, they can basically smooth out their different balance sheets through the competitive deposit side of the market. So long story short, the deposit rate will be constant in this model. It will be given by the risk-free rate or the discount factor rate of households. Okay, so this is the mechanism here from Burdett and Judd, which essentially allows us to explain why in equilibrium, there will be a loan price dispersion. So after this market, consumers borrowing and purchasing goods from firms, then they go to the next market, which is our neoclassical Voresian market. Think of this market as like a clearing house where the different types of people who expose have different wealth levels will either work more to top up their wealth. If they have too much wealth, they work less. And if they had borrowed, they pay back the banks. Those who didn't borrow, they basically get deposit interest from the banks, and then so on and so forth. So then the model repeats itself, all right? So this is an infinite horizon model. So we write down the dynamic programming problem for these agents. I'll just skip through all the math. And in the markets, in terms of firms are basically perfectly competitive in both markets. So it's very easy to pin down the pricing result. So the key mechanism in this model is this Burdett and Judd banking problem. Ex ante, think about a bank who decides to post some loan price I. The bank will have a profit, which is basically taking into account the measure of active buyers who potentially want to take out a loan. But there's alpha 1 measure of people who will face 1 bank. There's alpha 2 measure of people who will face 2 banks. So this bank has to take into account all these possibilities. So this is going to be the compound probability or measure of people who will be potentially coming to this bank here. RI here is the standard per customer profit, which is measured by the optimal loan demand by a consumer. Each consumer is indexed by whatever wealth in terms of money holdings that they have. This here is going to be heterogeneous. Again, back to the previous picture. We're looking at, this stage of the problem where within this stage, consumers can be different because they have different, potentially different wealth levels. Okay. So that's the loan demand of a particular consumer. And if this is the price the bank posts for loans, and this is the cost of funds, which is the constant deposit rate in the model. When I say constant, it's constant for a given inflation rate. But if inflation rate changes, this is going to increase accordingly, according to the Fisher equation. So then this gives you the per customer profit of the firm, of the bank. So then if you condition that by the equilibrium measure of people potentially showing up, that will be your ex ante profit for the bank, okay? What I want you to pay attention to here is that there is this object F, which is what the bank takes as given, but F is going to be endogenous. It's going to be the equilibrium distribution of loan prices posted by all the banks in the economy, okay? So when we solve for equilibrium, this will be pinned down endogenously. So crucially, this distribution will depend on things like inflation rate and therefore on monetary policy. And this is going to be one of the important objects that determines market power of banks. So long story short, what these banks are doing is they face a trade-off problem. On the one hand, they want to maximize profit by raising loan rate above the cost of funds, which is the deposit rate. But if they raise their margin too high, they face this extensive margin loss, meaning they have a lower probability of agents showing up to borrow from them. So this trade-off will be part of the consideration, and we can prove that in equilibrium, banks actually earn the same expected profit. Given that they earn the same expected profit, they will be indifferent to whatever price they would charge. So it will be as if the banks are offering a lottery of prices in the aggregate, okay? So from the consumer's point of view, when I go shopping for a loan, it's as if I'm faced with a distribution of loan prices and I have to draw one from that distribution, okay? So this is the essence of Burdett and Judd's theory. So we put it all together: consumer demand, banks, profit maximization problem, market clearing, and so on. Then we have monetary equilibrium. I'm going to focus on a notion of stationary monetary equilibrium. And we solve through the model. There's a whole bunch of propositions here, which I won't bore you with. But the point here is the following, that for sufficiently high long-run inflation rate or target, we have this result that people will demand less money. But in terms of the distribution of loan rates that consumers face, there's going to be a stochastic dominance result. For an agent whose real money balance Z is high, then they are more likely to draw lower ex-post markups. And for high enough inflation target, the banks will tend to be more worried about losing customers, and therefore they will tend to mark up less. In other words, they will behave more like Bertrand competitors. Okay, and then we have other results. We can prove that average markup tends to fall with inflation in the model. Let me just show you some pictures so that it's a bit nicer. So we estimate some of the parameters in the model to fit long-run money demand data and some macro data relating average markups and nominal interest. Notice that when we calibrate the model, we do not target things like dispersion. So that's going to be a byproduct of the calibration process. So as a result, we can then see that the model actually predicts the same kind of correlation we saw in both the raw correlations in the data, but also in the conditional correlations from the regression results that we saw. In particular, average markup is increasing with a standard deviation measure of dispersion. Alternatively, is decreasing with a coefficient of variation measure. Okay, so these are what's predicted in the data, and the model captures the direction, but of course, the magnitudes are not exactly the same. Okay, so jumping to what the model says, let's do a little comparative steady state equilibrium experiment. So imagine you have a set of economies distinguished by different long-run inflation targets. So then the question is, for different inflation rates, what happens to things like demand for loans, bank profits, and so on? In particular, when are banks essential? Given the short or almost zero time that I have, so let me just jump to the punchline. One, there's going to be a tension, as we said before. For low inflation rates, banks would tend to end up behaving in the aggregate as if they are more monopolistic, so they would tend to want to charge higher markups on average. But inflation, when it's high enough, then they will become more Bertrand-like or competitive. As a result, if you were to look at welfare comparisons, let me just take you through quickly. The blue line is our replication from the model. So if we turn off the noisy search part of our model, we get back the classic result of Berenson, Kammerer, and Waller, which is like a perfectly competitive bank, okay? So in other words, with a perfectly competitive banking sector, this blue line here measures the difference in terms of ex-ante welfare for the consumer, for actually everyone in the economy, because ultimately everything goes back to the consumer, so we can think of it as the welfare of the consumer. In the case where you have banks versus when you have no banks. So this is actually DW, a difference in welfare in these two scenarios. Notice this is always positive except when you are down here. At this very end here, this is the Friedman rule. Now we know that at the Friedman rule, if inflation is exactly equal to the rate of time discounting, then holding money is completely costless because it has the same return as a risk-free asset. Therefore, banks by definition would be not essential here. Then, whether you have them or not, it doesn't change welfare. Hence, the difference is zero. Away from the Friedman rule, which is where most economies would lie, this difference here is always positive. So that's the result of perfectly competitive banks by Berenson, Kammerer, and Waller. In our case, we have this green line. When you have noisy search, now banking market power matters, in particular for low inflation. Remember how I said the equilibrium mechanism is one where for low inflation, banks tend to exploit the markup margin more. They worry less about losing customers. So this is where they generate an ex-ante welfare loss for consumers. But for sufficiently high inflation, and not too high in fact, you start getting positive welfare gains from banks. Again, it's always below the perfect competition benchmark, simply because there's always market power by banks, all right? So hence, we get this slightly new result that says we have to be careful. Modeling banking sector competition is important. So as a result, this suggests that we could have a role for additional policy instruments. Here, we're going to set up an experiment where, imagine now you have a central bank which is equipped with additional active policy instruments. And this is like the Federal Reserve Charter that says the bank can use this additional liquidity provision policy. And we compare that with the case where the bank does nothing with these new set of instruments. All right. I wouldn't have time to get into detail, but the point here will be that the optimal policy will look, it's like we're solving a Ramsey policy. The optimal policy will say the following. Let's look at the blue line first. Again, we're coming back to the benchmark competitive banking sector. This is like the Berenson, Kammerer, and Waller model. In that case, the optimal policy is monotone across the different states of demand. So N here measures increasing levels of random shocks to the measure of active bias. So a bigger N means, from a Keynesian language, it means aggregate demand is hotter or higher, okay? So in the states where there's higher aggregate demand, the benchmark model will say, give people more transfers, more liquidity transfers. That's actually going to improve welfare, okay? In our model now, it will look somewhat like that. It's monotone increasing, but at some point it's going to turn around. In this example, we compute just for 4 possible states, but we did this for many, many different states. The stylized pictures keep showing up. So that's suggesting to us that there is a non-monotone effect. And where does that come from? Now, the green line is just the passive central bank. By definition, it does nothing. So this policy instrument is not active. The reason,
Tim,
yeah.
Sorry, can you speed up a little bit?
Okay, I'm going to finish off in about 2 slides.
All right, thanks.
Okay, so the reason we have non-monotonicity now in terms of this active policy is that the central bank has to worry about 2 things now. On the one hand, if it gives more transfers to people who need more liquidity, on the one hand, you're going to create more monopoly power. So you're giving more monopoly power to the banks. But on the other hand, there's this other force that as you give more transfer, you also benefit the consumers by lowering this dispersion in the rates that they face. So the balance of these 2 forces basically give you this non-monotone effect, okay? So long story short, you can improve welfare by using this additional liquidity provision policy. In terms of welfare, you can see that you can actually do better than the central bank that just ties its hands to inflation targeting. Of course, this is still lower than the benchmark competitive model because there's welfare loss in all states from market power. Okay, so long story short, when you have market power of banks, the answer to why banks are essential will be a conditional one. It depends. So if banks have market power, then this also affects the pass-through of policy to lending rates. As a result, you see this markup, in particular markup dispersion, and this is what we see in the data. And this implies that there's a potential for design for additional policy instruments for the policymaker, which is what we saw in the last experiment. Okay, I'm going to stop here. Sorry, I've gone over time a bit.
No, it's okay. So now we have some time left for questions. So anyone?
Yeah, Tim, thanks for your talk.
Thank you.
I've got a couple of questions or a couple of comments. I was thinking about this measurement question, whether you measure dispersion by standard deviation, the coefficient of variation.
Yep.
Can you go to your graphs that you showed us, the first set of graphs, about slide 4 or thereabouts? See, the standard deviation.
Yeah.
No, way before that. The standard deviation, that's your markup is in terms of a percent. So the standard deviation is going to be the same unit as the markup. So that's a percent too. The coefficient of variation, it's a little strange because it's going to be a percent divided by a percent.
Mm-hmm.
It's the standard deviation, percent divided by that. So I'm not saying it's wrong. The units are a little bit, you've got to think about that. But okay. you can get your bottom curves from your top curves, of course. The coefficient of variation, it's the slope of the tangent to a point on the curve in the top panel. That's the coefficient of variation, and it varies negatively. You can see from your picture there. Now, the related question is, when you do those regressions of just standard deviation on the markup, mm-hmm. you could say that what causes what? Does it go the other way around? Of course, you could consider the reverse regression. That's not what you want to do, I know, but you could do that at this level of sort of descriptive statistics.
I see.
But when you look at this equation here, this is very similar to this sort of never-ending literature on inflation and relative prices, whereby people have found, particularly in high inflation environments, that the dispersion of relative prices increases. So inflation somehow distorts relative prices. So we've got a breakdown of the distinction between real and nominal. And that coincides with a positive beta naught that you get too. So there might be some angle there that you could at least cross-reference.
Okay. Thanks for that suggestion.
The final thing is, in Australia, we've now got pretty much a separation of monetary policy, which is the Reserve Bank, from the banking sector structure and conduct, which is APRA. So that we've got two nominally independent institutions that deal with the two things that you talk about. So it's more difficult for them to coordinate activities. But I guess that may not be the same in the US. I don't know.
Yeah, that's a good point, actually. You know, macroeconomists, when they talk about optimal policy, fiscal monetary coordination as well, we always write down this stylized optimal program for a Ramsey planner, right? I guess that's kind of a hypothetical, wishful thinking optimal policy. We forget about politics.
Yeah, I understand.
Team, I pretty much have the same concern as Keen. I know your empirical part is not important, but it's very strange to say that very different results by using the standard deviation and the coefficient of variation. That's one point. The second one, on this regression on the screen, again, I don't know, maybe it's a very minor matter. Really, it's probably better to look at the bank level instead of state level, because the rest of your paper pretty much talk about the banks rather than the states. You should be able to get the same results. Instead of focusing on it's really, you're picking up the dispersion and markup across the states, right? Rather than across the banks or across the products.
Yeah,
but I
you're
think
right.
Maybe there are so few banks with so few branches within each bank, right? Because on average, I just saw the number in the chat box. There are only 4 branches for each bank.
That's why I think
4,000 banks.
Yeah, but Sean is right. So you said on average it's like 4 per bank, right?
Yeah.
Per owning bank here.
Yeah. So then the within bank variation is not that reliable.
Yeah.
But yeah, that's also one question. But still, my question was about the measurement. I think maybe you need to think more careful about the how to measure this markup.
Okay.
So, I think that leads to 2 things. The first is just Yanru has pointed out the difference between CV and SD. My guess is just now, for example, when the average markup increase, I think also the standard deviation increase. But the increase in standard deviation cannot catch up with the increase in average. That's the reason why CV just actually decrease.
That's right.
Yeah,
I think that's true in the data, and it's definitely true in the model. So we have both moving in the same direction, but the numerator, the SD, is actually going up slower than the average.
Yeah, that means the variation in the CV actually are mainly driven by the denominator, that is the average markup.
Yeah.
Rather driven by the standard deviation. Yeah, that's one thing. The second thing is because now you just use a unified benchmark to calculate the markup for all branches. That is a federal funds rate.
Yes.
Okay. Theoretically, no problem for me. You can make that assumption, but empirically, I think that could be a challenge, because as far as I know, even within the same bank, for different branch, the cost of that fund could be quite different.
Oh yeah, definitely. Okay. Yeah.
That means now a lot of the dispersion in the actual markup can also come from the cost side rather than from the price side. Now I think now your measurement, your argument is just okay. Now the markup is just totally the variation is totally from the price side rather than the cost side.
Yep.
But I think in reality there is a lot of dispersion in cost side.
So would it be safe to argue that maybe some of the things that you said is absorbed by these controls here? Even though we do not explicitly allow for
I do not know the branch control is just the geographic characteristic or other things.
So we have like branch level characteristics as well.
All right, gentlemen, my job is time management.
Yeah.
So I'll let the team quickly respond to Sean and then we'll wrap up. But by no means, like if you want to stay longer, you don't have to leave. You feel free to stay and then have more discussion with Tim. I'm sure Tim will be happy to answer more questions if you, Tim, am I right? You can stay longer?
Yeah, I'll be here.
Yeah. Okay, and otherwise, feel free to leave the room, and then if you want to stay, please.
Right. So yeah, just to quickly answer Sean. So I suspect, I could be wrong, by controlling for these branch level characteristics, we may have indirectly, captured the thing that you said we did not measure in terms of heterogeneous cost of funds across branches. But potentially we could do what you do as suggest as well. So maybe we'll give that a try.
Yeah, because I do not know what kind of data you have. Maybe you can get more information to deal with some concern from this aspect. Yeah. But anyways, even though some question I asked, but I think this is really important question you're asking. Yeah. So the market structure of the bank, I think it is very, very important. Yeah.
Thank you.
So Tim,
Tim, yes.
Yeah, sorry.
Following up with Sean's comments about the deposit side and inflation. Inflation and the cost of funding for funds are non-linear. Think about now European banks. They offer positive interest rate on deposit side, even though the European policy rate is negative. There are some reasons for that. They want to keep the deposit market working and so on. So it's something to think about when discussing whether it's an effect or inflation on loan pricing. And the other more philosophical question is, I mean, I understand search frictions in good markets, in job markets, but in a financial market for a consumer, I mean, if I need a credit card, I open Google, I search for credit card interest rate, I order, I choose the lowest interest rate in Australia, and that's all. There is, what is my search friction as a consumer, as a borrower?
There's still a limit to how much you will be searching, right? Like, even for me, when I buy airline tickets, I have a rule that
but that's a good product. In a good product, you care about the airline quality, you care about your seat. If I need $100 from every bank, it's $100. I don't care about the quality. And I can go to, I don't know in Australia, but many central banks, they offer you a report with the funding cost of every bank in the system. So I just go there, I choose the one with the lowest rate.
Right.
Why not choose the one with the toughest brand, with the strongest brand?
Yeah, I'm a classic consumer, such consumer where I'm still holding a mortgage. My rate is probably not the most competitive one. The reason was because, I went, like Ken says, I went with a bank that's reputable.
Okay, I see.
Yeah, but you have a good point, so I need to think harder about that. Thanks.
Tim, this kind of relates to what Andrew and Sean were pointing out, that like when you use this cross-state variation, there's not just the information cost that you're building in, there's also a usual just job, like the transportation costs per se as well. I mean, obviously many of these transactions are happening online. In the US, the interest rate you'll get in a different state compared to where you're working would also be different, right? So all those things are kind of clubbed into one at the moment, right? Yes. And so going back to what Yandre was pushing for, that within state variation, I mean, even if you have like 4 banks branches within a state, you should be able to calculate the variation and like use it, right? I mean, so what I'm asking is I'm struggling to see the econometric constraint that you're facing in terms of using the within state variation. So could you explain that a bit?
That's a tough question. So you're saying we're not using enough of the within state variation information?
Yeah, well, I mean, you're using all of them, right? Like within and across state. Within, actually not so much because you're averaging at the state level, right? But what I'm trying to ask is there a way to disentangle the effect of the information effect that you're talking about versus these other frictions like transportation, like, reputation, like credibility, right? And to do that, you might want to do the state one for sure, but you might also want to complement it with within state comparison and see how much the results differ.
That's kind of like, I think in various literature in political economy, even in banking, people exploit these border effects.
True, that could also be, definitely,
So that's going to be a more ambitious project, which I don't know if we'll ever get there, but we would like to at some point. To do that, then it would make sense to also have a structural model that can explain those regional variations, right?
Yeah. Right.
So at the moment, we are kind of behaving like,
There's the first model.
Macro group. So we wash out all these things. Thanks.
Thank you.
That's a good point.
All right. Do we have any more questions? No? Okay. Well, thank you so much, Tim. A lot of people leave the thanks in the chat box.
Thank you, everyone.
They didn't have a chance to say thank you. But on behalf of them, I'd like to thank you for giving this interesting talk, and I hope that you have some helpful comments on today.
Thank you so much, Tim.
Thank you.
All right, thank you.
And
bye.
have a good weekend, everyone.
Yep, thank you.
Tim.
All right, take care.
Keep up with the good work.
Thanks.